Well, the Sensex and the Nifty fell for the second straight week. Both indices have given up 1% each. Financials led the fall, with the Nifty Bank Index posting a loss for the fourth consecutive week. Hello and welcome to Editors Roundtable. Today we talk about a lot of things. First, of course, we compare the valuations of HDFC Bank and ICICI Bank. We also take a look at the stocks who saw the biggest single-day fall since 2021. That's not all. We get you a comparison between two Motown majors, TVS Motors and Bajaj Auto. And as we inch closer to the interim budget, we lay out the key expectations from Dalal Street. I'm Sonia Shenoy, and today with me are the editors Anuj, Nimesh and Prashant. We also, in fact, have Rahul Arora, the CEO of Nirmal Bang Equities, who's here with us. Gentlemen, thank you for being on the show. It was really a week where the bulls sort of caught their breath, because I think the uptrend has taken a bit of a pause now. We can all safely say that. And it was also a week where there was a lot of volatility. One really doesn't know which way things could go.
Oh, absolutely.
It was 3 days, by the way.
Exactly. But that's because last week we worked
for 6
days, right? So anyway, look, I mean, it happens, right? The market, January has been that kind of a series.
Yeah.
I was making a point that this is a market which reminds you of that Ajit dialogue. Like Robert इसे liquid oxygen में डाल दो, liquid इसे जीने नहीं देगा, oxygen इसे मरने नहीं देगा. And the market's going through that. IT till at least today, IT was not letting it fall, but banks were not letting it go up, and the market was all over the place. But suffice to say, we've seen some kind of a pause or a correction in the market for sure.
Some kind of a pause or a correction. Rahul Arora is also here with us. Rahul, how are you feeling about the market? Is it on liquid oxygen or what?
More liquid than oxygen, I think. I think the best piece of news, Sonia, I think if you were a bull market investor, and this may be a slightly lateral way of looking at it, is the near 20% fall in HDFC Bank. And I think that if I was a bull market investor, that actually gives me hope, because if this is one bank you want to buy and it's underperformed, if it recoups that, then the Nifty could potentially be back 1,000-1,500 points. So I think not too disturbed, because I think at 22 and plus we were about 1.5 standard deviation above mean. If you look at 5 and 10 5-year average and 10-year average on Indian 1-year forward price to earnings, even on EV to EBITDA, you were 1.5 above standard deviation. So I think a welcome pause, as you called it, but I'm taking heart from the fact that this is just a pause before the next move up, so to speak.
Okay, a pause before the next move up. I also wanted to, get your view in on the mid-cap space, because, we've had this kind of pressure in the mid-caps, especially because of the valuations, right? Valuations of mid-caps are not looking cheap compared to large caps, and in fact very expensive. So how are you feeling about that?
Well, I'll give you a tongue-in-cheek answer. When one of my competitors comes out with a report valuing Dixon Technologies at 65 times FY26, it sums up the whole market. In a way, I think it's not an easy market to find value. I was listening to, on the way here on the Money Control app, your interview with Sandeep Tandon, where he was talking about value being a decadal-long theme. But it's not easy to find that kind of value, because even where value existed a year back, I mean, whether you look at defense, PSUs, I mean, some of these, to buy them today and then to, expect to get 10-15% continuous returns, I don't know. But all things said and done, like I said, Sonia, see, I think we're entering a year where rate cuts are going to be the big theme as time goes on. And I think in that backdrop, if the US does not enter a recession, I don't think we're going to get any meaningful 20-30% kind of corrections. I think every dip is going to be bought into. And if you have good quality stocks like an Asian Paints or a Bajaj Finance or an HDFC Bank that keep falling from time to time, which are godsend opportunities, where people wait for them, you go in and start buying these opportunities. But mid-caps, I think, have had a remarkable run. SIP flows at, what, $2 billion a month. It's unbelievable. It's bound to find its way, but I think this could potentially be the year of large caps as opposed to mid caps.
This really has been a tough question, right? It has no easy answers. As Rahul said, tongue-in-cheek. Sonia, it reminds me of that con call that Tech Mahindra had yesterday to a question. I think the CEO said, this is such a tough question. You're asking me a question like, it's similar to asking, have you stopped beating your wife? You get implicated both ways, whether you say yes or no. So it's, asking a question whether mid-caps will still outperform from here or not.
It's a tricky one.
It's a tricky one.
But then there's another very tricky question, right? That's on HDFC Bank. I mean, that these are companies that are, of course, great in the longer term, but in the shorter term, there's just so much happening that you don't know which way it would go. But Anuj, you've put together some data on ICICI Bank versus HDFC HDFC Bank and how it's pipped HDFC Bank to see its valuations, I think, which have beaten HDFC Bank for the first time ever.
And I'll tell you one thing, if it wasn't for HDFC Bank and its history behind it, its legacy behind it, this would have happened much earlier, and I think HDFC Bank would have fallen 40 or 50% if it wasn't HDFC Bank, based on what has happened over the last 6 months or last 1 year. But anyway, let me just go to the big wall and put it in terms of numbers, because, as you rightly pointed out, for the first time, at least since I have started tracking equity markets, and that dates back to 2003, ICICI Bank has overtaken HDFC Bank in terms of valuations. As of yesterday, ICICI Bank is trading at 2.9 times price to book value, and HDFC Bank has come down to 2.6 times price to book value. Yes, you're reading it right, 2.6 times price to book value. Now, just to go back, in 2010, when HDFC Bank was really the HDFC Bank, at that time it used to trade at 6 times price to book value, and ICICI Bank used to trade at 2 times price to book value. After that, you started to see, of course, some moderation, and the new normal for HDFC Bank was 4 times price to book value. Below 4 times price to book value, it fell once after COVID, but that was an aberration. And after that, in 2021, it fell below 4 times for good. And after that, it's consistently derated, and it reached a stage where after this quarter's numbers, it has fallen below 3 times price to book, I think for the first time in my memory. Maybe Rahul will have more details whether it's traded at these valuations earlier ever. Of course, ICICI Bank, on the other hand, is almost reaching its peak valuation. And if you look at the next plate, what's going to be very interesting is the stock returns. If you look at 1 month return, 6 month return, 12 month return, and 5-year returns, 1 month return for ICICI Bank is flat. It's not as if over 1 month or 6 months ICICI Bank has raced through, but HDFC Bank in same period has fallen about 15%. Over a 1 year period is the underperformance really stark. 16% up move for ICICI Bank, 13% downtake for HDFC Bank. That is 30% underperformance. And if you're looking at a 5-year period, ICICI Bank has gone up 180% in that 5-year period, and HDFC Bank has gone up only 37%. It's not even beaten the fixed deposit. I mean, you would have made more money in HDFC Bank's fixed deposits rather than you would have made in the stock price. And there's a very interesting report which has come from Macquarie, which is the title is "Long Journey Ahead" on HDFC Bank, and their point is that names might pick up, but they'll pick up earlier only by yield pickup, and only during the later part will you see the pickup be driven by the replacement of these high-cost liabilities that you acquired from the erstwhile HDFC. So, of course, that's been the big debate this week, that whether HDFC Bank will see more derating or it's already done enough by now.
Okay, Rahul, what about you? Your view on it? HDFC Bank, do you buy now or do you stay away?
As I said, Sonia, I think, at times you look for falls like these to buy good companies, and I've seen this happen to Bajaj Finance. There was a time when Bajaj Finance fell about 50-60% and it recouped its entire losses. Just to take Anuj's point forward, if you compare HDFC Bank and ICICI Bank on return on assets, return on equity, capital, tier 1, tier 2, net interest margins, as we say in Hindi, 19-20 ka farak hai. It's pretty much they're almost identical, including the growth rates that are projected on a standalone basis. They'll pretty much be about the same. The only advantage I think ICICI and the group could have over the HDFC group is that there are potential subsequent listings that could happen. I think for HDFC, the entire family has already gone through that. If I'm not mistaken, ICICI Prudential Mutual Fund, which is an unlisted company, operates at a 35-40% return on equity. So there is some amount of value unlocking that could potentially happen. If SBI decides to list its mutual fund arm, and the reason I'm bringing this up is because Canara Robeco recently got an approval for its listing. So that'll be the next mutual fund. So there could be certain trigger points for these entities which are very large competitors for capital to HDFC Bank. So it is possible that the last decade belonged to HDFC Bank and this decade belongs to probably ICICI Bank and HDFC and State Bank of India. But to say that the story is over, I wouldn't think so. I think, my mind goes back to a statement that Rukshaad Shroff had made at our CFA conference a few years back when he was heading the investments at Jardine. It was about 6-7 years back, and somebody asked him, what is the next HDFC Bank? And he said HDFC Bank is the next HDFC Bank. And that was a very famous statement at that point in time. Of course, Jardine was holding a very large, had a very large position in HDFC Bank at that point. But look, I take Anuj's point, but at 2.6, 2.7 times price to book for a combined entity that's going to grow at 25-30%, I'd take it. I mean, I'd be a buyer into this name for sure.
Okay, we'll revisit this thought, right? After maybe, let's see, I mean, 12 to 18 months down the line. As they say, it's best to be greedy when the market is fearful. So I guess that's the most prudent strategy.
I mean, it can go into periods of consolidation. I mean, your parent Reliance went into a 10-year consolidation. Hindustan Lever, I remember when I was looking at it, went into a 10-year consolidation. And there are periods, it could go nowhere for a while. But when it does, you don't want to be under-owned at that point in time. That's my limited point, because you know, what's to say a couple of quarters from now, you know, see, deposit rates are going up at the short end. Everybody knows that. NIMs may be under pressure in the next 1 or 2 quarters. But what happens a couple of quarters now if HDFC Bank, you know, sort of beats expectations, and there's a technical factor of it being marginally under-owned. It's never going to be massively under-owned, but say 100, 200 basis points. Then you may get that 15-20% in a week.
Correct.
And as a fund manager today, when I know 20-30% of my CTC is locked into my funds, do I want to take that risk on a name like HDFC Bank? I'm not so sure. So I think most people would view it as a buying opportunity. Even if it tests for time, I'd be relatively more comfortable playing that, rather than playing some other large cap names where there may be some other external triggers. I mean, this is all known. It's just coming out in the price. They've flagged all of this off. Fair enough, you know. It was 3.5 times. It's come down. I mean, how much worse can it potentially get from here? You look at a risk reward. If it goes down another 10%, but it could go up another 30% from there at a 3:1 risk reward, can I take that trade? Why not?
Okay, that's a fair way to put it. But from HDFC Bank last week to Z this week, many stocks have seen their biggest single-day fall since COVID. Nimesh has actually put together some very interesting data. Nimesh, what's the key learning from all of this?
You know, I'll go to the wall and explain. But you know, Sonia, this was a month when we saw 3 large liquid names seeing big accidents, right? Polycab 20% down, Z down 32%. HDFC Bank we all spoke about, that was down to more than 10%. So let me just go to the wall. The history will give you an answer on what needs to be done when there is a big single day fall in individual stocks. I've just looked at the data. I've looked at the selection criteria is BSE 500 stocks. I've looked at the criteria which includes disappointing earnings, corporate governance issues, or for that matter, there is an event-driven event in a particular stock. That's been the large criteria. Now, as I said, right, this month, we've seen 3 big, accidents, so to speak, in the stock market. The first one was Z Entertainment, fresh to our memories. In single day, the stock was down 32%. HDFC Bank on disappointing numbers saw more than a 10% fall in a single day. In Polycab on that IT rate, that was on 20% in a single day. So I've just classified all the 10 stocks of the last, say, 2 years into different categories. One is the earnings impact category. Second is corporate governance issues. Third is the event-driven names, the likes of Z Entertainment and Adani Group stocks. And the fourth one is new age companies, the likes of Zomato and Paytm. Now look at individual names as we speak on their impact. The first stock is Z Entertainment. Fresh to the memory, we saw 32% fall in a single day. We all know the reason, because of the Sony merger getting terminated. Now we need to see what happens after the event in a year's time and event till date. Of course, it's a fresh event, so we don't have much of an history. But the stock has recovered a bit, but we need to see how things pan out as far as Z Entertainment is concerned. Now, let's look at the other stocks. Same time last year, we saw the big Adani Hindenburg saga, and on a single day, all the Adani Group stocks were down. I've just taken Adani Enterprise as an example. 28% down in a single day, but after that, in a year's time, the stock has recovered 35%. Of course, it's a 1-year history, so even to date also, the stock is up 35%. But look at other names now. Paytm, on the day of the listing, that stock ended almost 27% lower. Of course, higher valuation was a big concern there. 1 year after that event, the stock is down 65%. And even till date, in the last 790 days, the stock is still down 15% from the listing price. So that's been a bit of a niggling stock. RBL Bank, in June 2022, we saw a big reaction. On a single day, the stock was down 22%, largely on back of RBI to come and appoint a new MD and CEO. But in 1 year after that event, the stock is up 105%. And since the event date up till now, the stock is up almost 2 times. It's gained nearly 196% in the last 600 odd days. So that's the RBL Bank. The next stock is Polycab. Again, fresh to the memory. It's a this month story. On a single day, the stock is down 21% on the reports of that IT rates. Even to date, the stock has recovered a bit from the lows, but we need to see how that pans out over the next 1 year or so. The next stock on the list is going to be Vedanta. This is interesting. On October 2020, the stock was down 20% down circuit because the delisting got rejected. That time the stock was just 88 rupees. After that, in a year's time, that stock rallied 225%, and even to date, the stock is still up 176%. That is Vedanta. which was down on a single day 20%. Now, Gland Pharma, that's an earnings impact. On a single day, that stock was down 20% on May 2023. But after that, in the last, say, 8 odd months, the stock has recovered almost 80 odd percent. Similar is the case with a couple of other earning disappointments. Amber Enterprises, down 20% in a single day after the earnings in May 2022. But after that, the stock has recovered almost 40 odd percent in the last 1 year or so. That's Amber Enterprises. Even a couple of other names which saw on earnings disappointment. Tanla Solutions, again down 20% post earnings. But after that, in a year's time, the stock is up 70%. And even to date, the stock has nearly recovered almost 45%. Similar is the case with Zomato as well. These are all new. This was a time when New Age Technologies fell sharply. On a single day, Zomato was down 19-20 odd percent. And after that, even till date, like in the last 730 days, the stock has almost recovered 50 odd percent from the low. So the key message from the history, if you look at single day correction, is if there's an intrinsic value, stocks do bounce back and they give handsome returns. But we need to be very careful on what you're buying and what is the intrinsic value for those stocks.
Okay, in fact, that's a very nicely put together piece. Rahul, did you track the developments in Z, and what's your view on that stock?
No, so Anuj, formally we don't cover the stock, but I think obviously it was a setback because I think the entity that you were merging with, I think Z standalone does far better at a regional level than it does on a national level. And I think the kind of properties that Sony has, Anuj, it would have leveraged so much more, right? I think right from, KBC to Shark Tank to, the dance and the singing shows, Indian Idol, sports, which has become so big for them. Obviously, this would have been a huge step forward for Z, especially since you were talking about, how things changed from a management standpoint and the news flow surrounding it. But not entirely surprised to see the stock price reaction. I'm not entirely sure at an individual level if I'll go in and want to buy Z as on today, but it would have been a huge re-rating potential had this deal gone through.
But is that, Rahul, a de-rating event for the entire sector? Because now people are questioning about valuation for other M&A deals as well. And none of the media stocks in general has made money for investors in the last many years.
No, so I don't think one M&A specific can probably take a call on the entire sector. That's probably not the way I would look at it. I think media obviously has its cycles. I think this year potentially could be a very good year. You are 3 months away from a general election. So both from an advertising and a subscription revenue, I think this quarter and this potentially even post that when you go into the next budget. So I think this could be actually a fairly good year for media in that respect. Could these be secular investments or secular stories to buy? I'm not really sure, because from time to time you need to keep making investments. So I don't know if these are consistent free cash flow generating businesses, Nimesh, but I would hesitate to just extrapolate this event on the entire sector.
Okay, the other space that was in focus this week was the auto sector. We had two numbers that came out, Bajaj Auto and TVS Motor from the two-wheelers. It was very interesting. It was a tale of two cities actually. By the end, Bajaj was up and TVS was down. So we decided to do a bit of a comparison of both. And Rahul, I wanted your view on them as well. Let's explore how the two results compare to each other, right? Let's begin with the margins. Now, Bajaj Auto's margins scored over TVS Motor because they did better than expected, and they did well despite the, the adverse product performance. So if you look at it, the product mix, right, they had lower contribution from three-wheelers, and despite that, Bajaj Auto managed to come out with margins at 20.1%, while TVS Motor margins were at about 11.2%. Elara Securities put out a note where they said that margin resilience is impressive for Bajaj Auto despite the adverse product mix. The three-wheeler contribution was down 300 basis points quarter on quarter. This implies that Bajaj Auto's margin performance is not overtly dependent on the three-wheeler performance. Let's look at the net realizations as well. Bajaj Auto once again scores over TVS Motor in that front. The net realizations for Bajaj Auto went up 6.5% year on year, while TVS Motor's net realizations barely went up about 0.6%. Now, I think the biggest brownie points for Bajaj Auto is on valuations, because it's much cheaper than TVS Motor at this point in time. So Bajaj Auto is now trading at 20 times forward FY26 compared to TVS Motor, which is trading at 27 times FY26. So clearly it wins the valuation game argument for sure, but it also scores in other places like margins, operating performance, etc. Do you think as an investor you're better placed to pick Bajaj over TVS? What's your view?
One very important data point, Sonia, which you could have added to your update was dividend yield. I think Bajaj Auto is a 3.5% 0% dividend yield company. TVS is, I think, sub 1%, 0.7. So that huge arbitrage is there. I mean, you're pretty much getting half your GSEC in a Bajaj Auto dividend yield. But I think that being said, I think you've summed it up pretty well. I think the return ratios of Bajaj Auto are far superior to TVS. I remember one of our very large institutional clients had bought about 1 crore shares at 40 rupees, one of the top 5 mutual funds then. So it's been, what, a 50 bagger from there. And the biggest story in TVS at that point when he bought there, it used to be a 4-5% margin company. And the call he took was, iska margin 10-12% ho jayega. And to TVS's credit, it has delivered spectacularly to that effect. The question is what from here? I think when you look at the return ratios, the margin profile, the export capability, especially what Bajaj has managed to do on the premiumization as well, while not ceding too much market share at the entry level to Hero incrementally, I think at this price for this valuation, I think the trade is clear. I think it's Bajaj Auto over TVS for sure. And I think I would even probably say Bajaj Auto, Hero, and then TVS, because even in Hero, if you are not entirely convinced about the market movement or where it's going to go, again, it's a 3-4% dividend yield company. These things matter a lot in an uncertain or a volatile environment. So I think those two would be the preferred picks in the two-wheeler space, right?
Okay, let's do one thing. Let's take a quick break on that note. On the other side of the break, the market's expectation from the budget. It is a vote on account, but are there any expectations from the market? Stay tuned. We'll come back with more.